All right, today we're going to talk about personal cash flow. Why are we talking about personal finances in a business meeting? Well, because for most small business owners, most sales professionals, our business finances are just hardcore linked to our personal finances. And we can't really make good, informed business goals unless we have control over finances. Because what happens is that it just never, it's never enough, right? It's never enough. Everything's always tight. You're always, you're going out there, you're hungry, you're thirsty, you're afraid, and you make bad business choices because your personal finances are out of control. And so, for me, being a person who has variable income, I created this system actually out of need because for me, I'm in a seasonal business. We get busy in the summer and we kind of slow down in the winter. And I've had just one too many tough Christmases. And so this system has been really helpful for me, and I want to share it with you. I also call it the bucket system. So sometimes you'll hear me refer to it as the bucket system. And appropriately named because I use these paint buckets. I mean, obviously, I'm a house painter. So here's how it works. You've got your needs, you've got your wants, you've got your safety, you've got your goals and your future. And so when that income comes in, and again, if you're an entrepreneur, if you're in sales, likelihood is you have a variable income. Now, if you have a fixed income and you have a salary and it's the same every pay period, this system's still going to work. It's still going to work just fine. It's just a little more simplified for you. But when you have variable income, it's kind of complex. But this simplifies it. So how it works is you have a needs bucket. And what you're going to do is you're going to set up a bank account, just a regular old checking account, and everything that you have that is a need, your house payment, your utilities, your food, your all the things that you need, you're going to tally up what that is on a monthly basis, and you're going to set a limit to how much that is, whatever it is. It could be anything. It could be $3,000, $5,000, $10,000. I don't know what your life is like, but you just set that fill line. And what you do is you fill that bucket up until it gets to that line. And once you fill it up to that point, then you pour the money over into another account that you call your wants account. And the wants are for a lot of those variable, unexpected things, the things that are fun, things that, maybe it's entertainment, maybe it's restaurants, that kind of thing. And, the hard part about managing finances is that a lot of times, most of our purchases are impulse purchases. About half of them are impulse purchases. And so we just don't have a good container on it. And so what this does is it says, okay, we're going to put a container on this spending. And once we spend it down and now we're out, then we're not going to spend any more on it. Okay. And you can have as many wants buckets as you need. In my house, we tend to split it up between shopping, restaurants, that kind of stuff, right? And we just get different, online banking accounts, and we have the different cards. And when we go shopping, we use the shopping card, and when we go to restaurants, we use the restaurant card. So you fill it up, income comes in, you fill up the needs account, you fill up the wants account, and then the remainder goes into that safety account. And the safety account, it's you may have done another type of financial system, and you might be familiar with an emergency fund. This works similar to an emergency fund. However, there's one key difference, and that's that it's a little bit more fluid because our income is variable. And so instead of, say other systems that would have you prioritizing getting rid of debt as fast as possible, well, we know that our income is variable. We know that it's up and down. We know that, certain seasons our sales just drop and so does our income. And so what we want to do is we actually want to make sure that we have enough money in the bank to account for those slow seasons so that when the sales aren't in, we pull from that safety account and we've covered the deficit, right? We've smoothed it out. It's kind of being the ant and the grasshopper. We'll fill that line up until it hits that point of, we can cover most slow seasons with this amount of money, and the remaining cash flow, it goes into either your goals or your future. The goals are things like vacations, buying a car, paying down debt, education, stuff like that. And then your goals are things like your future, like investment accounts, uh, real estate, and even new venture creation, which is my favorite. So that's the five bucket system, or the bucket system. And one of the things that really, really helps is putting all of this on a calendar. And so what me and my wife do is we have a big paper desk calendar that we put on our calendar, and we don't schedule events and things like that are coming out. We schedule the money. When is our phone bill coming out? When is car insurance coming out? When is the electric that coming out? And that way we can see when the money is coming in and when the money's going out. And if there's kind of a mismatch between, you have a bunch of bills that come out at the beginning of the month, but that happens to be kind of your slower period, then you need to call up some folks and say, hey, can we move this payment later in the month, right? And so you can use the cash flow calendar to set a budget. It's really great to have it on that big paper calendar that you and your spouse can see, and plan out your finances. If you do this, you're going to have better slow seasons. You're not going to be sweating as much. And if you're not nervous in your slow seasons, you're going to make better business decisions.